If you still think silver is $91, you're already $9 behind reality. The government knows it. The vaults know it. The only question is, do you? The United States government just blinked. For decades, they told you the price of silver was determined by a computer in New York. They said paper contracts and algorithms were the real price discovery mechanism. They said physical supply was irrelevant. That illusion shattered today. We have an official communication from the United States Mint. To the untrained eye, it looks like a customer service update. To a forensic analyst, it is a confession of systemic failure. The U.S. Mint has suspended all sales of silver numismatic products. Let me repeat that. The government has stopped selling silver. The official notice claims it's due to pricing adjustments. They say rapidly rising prices force them to pause until they can figure out how to price their products. This is not a glitch. This is a physical default at the sovereign level. The U.S. Mint is a manufacturing entity backed by the Treasury. If they cannot price a 1-ounce silver coin in real time, it means market volatility has exceeded the bureaucracy's capacity. But the deeper implication is terrifying. When a business stops selling during a price spike, it's usually because they cannot replace inventory. If the Mint sells you an eagle for $100 today and silver gaps to $110 tomorrow, they lose money. More importantly, they lose the ounce of silver. If they cannot buy it back because refiners are empty, they are liquidating national wealth for depreciating dollars. They have realized the silver is worth more than the currency. The suspension is the break glass signal. It is the moment paper price and physical reality violently diverge, freezing the system. We are now in the no-offer phase of the bull market. Imagine walking into a grocery store. The shelves are packed with milk and bread. But when you go to pay, the clerk refuses the sale. He says, "Sorry, the price of milk is rising too fast. We are suspending sales." What does that tell you? It tells you the currency is failing. The store owner would rather keep the milk than take your cash. That is precisely what the U.S. government just did. The Mint suspension creates a psychological shockwave through the entire dealer network. The private dealers, APMEX, JM Bullion, SD Bullion, they look to the Mint for guidance. When the Mint closes its doors, the dealers panic. Their supply of silver eagles, the most recognized coin globally, is cut off at the source. This triggers an immediate scarcity loop. Dealers will raise premiums to protect remaining inventory. If they cannot get more eagles, they must ration what they have. We are already seeing premiums detach completely from the $91 spot price. The street price is now untethered. This event is the ultimate scarcity marketing. By telling you that you cannot buy it, the government has confirmed it is the most valuable asset you can own. The pent-up demand from today's blocked buyers doesn't vanish. It spills over into bars, rounds, and the broader market, creating a vacuum effect. The entity that prints the money is now hiding the metal from its own citizens. The signal could not be clearer. If the Mint closing was the defensive move, what happened in the commercial vaults was a massive offensive strike. While retail was being locked out, a single entity executed a coordinated raid. We analyzed the CME depository statistics. The data confirms a staggering withdrawal. Over 1.3 million ounces of silver were physically removed from the JPMorgan Chase vault in a single day. JPMorgan is not just another bank. They are the fortress, the custodian of the largest silver stockpile in the COMEX system. Their vaults were considered the backstop. The assumption was that JPM always had the metal. Yesterday, the fortress was breached. This was not an accounting adjustment. The metal didn't just move columns, it was withdrawn. That means loaded onto trucks and gone. It has left the COMEX ecosystem entirely. Who has the power to move 40 metric tons of silver in one day? This is not a coin dealer. This is a whale, a sovereign wealth fund, a central bank, a massive industrial conglomerate. The bleeding was systemic. Another 600,000 ounces left Brinks. 200,000 ounces left CNT. In total, nearly 1.8 million ounces vanished from the depositories in 24 hours. This is a bank run. But instead of people at an ATM, it's strategic entities at the warehouse, withdrawing bars. They are doing this for one reason: counterparty risk. The entity that took that metal knows something. They know the $91 paper price is a fiction. They know inventory reports are thinning. They know if they leave their metal in the vault, it could be leased out or rehypothecated to cover the bank's massive short positions. So they are taking possession. They are following the rule: if you don't hold it, you don't own it. But the most bullish detail is where this silver came from. It came from the eligible category, the metal owned by long-term investors that is supposed to be sticky. When eligible silver leaves in million-ounce blocks, it means the old money has decided the COMEX is no longer safe. The trust in the institution has collapsed. This is the death knell for the paper pricing mechanism. The smart money is not selling at $91. They are taking delivery. They think $91 is cheap. They are preparing for a repricing event that will make today's move look trivial. The government is hiding the metal. The whales are taking the metal. You are left with a choice. Believe the official narrative or believe the empty shelf. So we have the government shut down in the vault raid. This leaves one final variable: the price. What is the real price of silver? If you look at your screen, you see 91.67. That is the number the COMEX computer says silver is worth. It is the price the algorithms trade. It is the price the media reports. But we have a reality check from the other side of the world that proves that number is a lie. We have confirmed data from the physical markets in China. Silver is trading between $98 and $100 per ounce. Let that sink in. There are now two prices for silver on planet Earth. The Western paper price of $91, the Eastern physical price of $100. This is an arbitrage gap of $9 per ounce. In finance, this isn't an inefficiency, it is a vacuum. It is a black hole sucking every available ounce of metal out of the Western Hemisphere. Think about the physics. If you are a bullion bank or a trading house, you are looking at a risk-free money printer. You can buy a contract on the COMEX for $91, take delivery of the bar, fly it to Shanghai, and sell it for $100. You make an immediate, guaranteed profit of nearly 10% in days. This trade is happening right now. It is the reason the vaults are emptying. It is the reason the mint is closed. The metal is flowing uphill to the highest bidder, and the highest bidder is China. This signifies a historic shift. For 50 years, price discovery lived in New York and London. The West set the price and the East took it. Today, that relationship has inverted. Shanghai is now the price maker. New York is the price taker. China is setting the price based on physical supply and demand, on the needs of their solar factories and battery plants. New York is just trying to keep up, dragged along by the arbitrage. This means the COMEX price must rise to $100. It is a mathematical certainty. If the COMEX price stays at $91 while Shanghai is at $100, the drain will continue until the COMEX has 0 ounces left. At that point, the exchange defaults. To prevent a default, the COMEX must close the gap. The paper price must rise to meet the physical price. This is why we see such violence on the charts. This is why we see vertical candles. The market is frantically trying to reprice itself to reality before the inventory runs out. Why is China paying 100? Why aren't they waiting for a dip? Because they know the dip isn't coming. The Chinese industrial complex understands silver is a strategic mineral. They know that without it, they cannot dominate the green energy transition. They are willing to pay whatever it takes to secure the atoms. They are not speculating. They are hoarding. The Shanghai reality check explains the panic at the US Mint. The Mint buys silver blanks from private vendors. Those vendors operate in the global market. The US Mint likely called its suppliers and offered to buy silver at the spot price of $91. The suppliers laughed. They said, "Why would we sell to you at $91 when we can sell to Shanghai at $100? The US Mint got outbid. The sovereign government of the United States was priced out of its own currency market by the physical reality of the East. That is the real reason for the suspension, not a glitch, a refusal to pay the real market price. This is what a currency collapse looks like in the early stages. It isn't just the number on the bill getting bigger. It is the goods disappearing from the shelves because the currency is no longer accepted as a valid store of value by the producers. We are seeing the bifurcation of the world. A paper world that is crumbling and a physical world that is repricing. Now we arrive at the final calculation. The mathematics of extinction. The arbitrage drain is creating an irreversible inventory loss. The banks can print infinite paper shorts, but they have finite physical ounces. Every day the $9 gap remains open, millions of ounces leave the system. This drain has a mathematical endpoint. The retail supply chain is downstream from the commercial vaults. If the commercial vaults are being drained by whales, the river runs dry before it reaches the retail investor. You are witnessing a crowding out effect. The big fish are eating all the food, and the little fish are left starving. This creates a terrifying setup for the price. We are trading paper contracts that represent metal that is rapidly disappearing. The JPMorgan drain is the smoking gun. It proves the smart money is not selling. They are taking delivery. If they thought $91 was a bubble, they would be selling their metal into the market to cash out. They would be increasing the stockpiles, not decreasing them. The fact they are withdrawing metal at all-time highs tells you everything. They think $91 is cheap. They think $100 is the starting point. They are preparing for a repricing event that will make the current move look like a rounding error. The no-offer phase of the bull market is here. This is when physical metal is simply not for sale at any price. The retail buyer finds empty dealer shelves. The industrial user finds no wholesale supply. The price on the screen becomes irrelevant because it cannot compel a seller to part with their metal. The drain from the eligible category is the critical variable. This is the long-term strategic metal. Its exit signals a permanent loss of confidence. It is not coming back. This metal is likely on a cargo plane heading across the Pacific, moving from a market that suppresses price to a market that pays fair value. The mathematics are simple. Declining supply against inelastic demand equals exponential price discovery. The industrial demand from the East does not care about the price on a screen in New York. Their factories need silver to function. Their demand is inelastic. They will pay whatever it takes. This creates a feedback loop. Higher prices in the East widen the arbitrage gap. A wider gap accelerates the drain from the West. A faster drain creates greater scarcity, which pushes the Eastern price even higher. The loop continues until the Western paper market is forced to capitulate and gap up violently to shut off the arbitrage. The math doesn't just suggest higher prices. It demands a catastrophic repricing to prevent a total physical default of the entire paper silver market. The system is now hostage to physics. So where does this stop? Is $91 the top? Is 100 the top? To answer that, we have to look at the psychology of the triple digit. 100 is not just a number. It is a barrier in the human mind. For decades, silver has been seen as the poor man's gold, trading in the teens and 20s. The idea of silver costing $100 an ounce seemed impossible to the average investor. But today, with the Shanghai price hitting that mark, the impossible has become the reality. When the COMEX price finally gaps up to meet Shanghai, and it will likely within the next 48 hours, it will trigger a global media frenzy. $100 silver is a headline that writes itself. It will be on the front page of the Wall Street Journal. It will be the lead story on financial networks. And when the public sees silver hits $100, they won't think it is too expensive. They will think, I need to buy it before it goes to $200. This is the paradox of a Giffen good. As the price rises, the demand increases because the rising price confirms the value and the scarcity. The United States Mint has just poured gasoline on this psychological fire. By suspending sales, they have told the public that silver is hard to get. Nothing makes a human being want something more than being told they can't have it. When the mint finally reopens, whether that is next week or next month, do you think demand will be lower? No, it will be exponentially higher. People will be lining up to buy at any price just to secure a piece of what the government itself is hoarding. So $100 is not the ceiling. $100 is the starting gun for the mania phase. But we must also look at the monetary logic. Why is silver rising? It is the dollar failing. We are watching a real-time devaluation of the United States dollar against hard assets. The drain of physical assets from west to east confirms this. We are watching the sovereign crisis move from the bond market to the commodity market. When a government cannot borrow money cheaply and cannot source strategic resources, it is losing its sovereignty. It is losing control over the economic destiny of the nation. This is why you must hold your position. I know the temptation to sell at $90 or $100 will be extreme. You will look at your gains and feel like a genius. You will want to cash out into dollars to lock in the profit. But you have to ask yourself, what are you locking in? You are locking in a currency that the US Mint itself is struggling to price. You are locking in a currency that is being rejected by the physical markets. You are trading a scarce strategic monetary asset for an infinite, depreciating political liability. Do not sell your silver for dollars. The exit strategy remains ounces to assets. You hold your silver until the mania creates a distortion in the other direction. You hold until you can trade your ounces for land, for a business, for cash-flowing real estate. Right now, at $91, silver is just catching up to inflation. It is just waking up. Historically, it took roughly 800 ounces of silver to buy the average American home. Today, it takes thousands. We have a long way to go. The ratio of gold to silver is also critical. With gold at new highs, the ratio is compressing toward its geological reality. If silver returns to its natural ratio, the price would be over $300 an ounce. That is the target. $100 is not the end. It is the beginning of the reckoning. The sovereign admission of failure at the mint is the signal we have been waiting for. The wealth transfer is happening. It is moving from those who trust the government to those who trust the metal. The mint is closed. The vault is open. The price is vertical. The bridge is burned. There is no return to the world of $20 silver. That world is gone.